Welcome back to the Florida Seaman Group here in Chicago. Thursday, September 15th. I'm Killer. Let's get straight into the zone, folks. The CMZ zone. Overnight, we saw this ECB action, this 3-month U.S. dollar liquidity, essentially. And I think that was a nice little stitch in the wound, or in the words of Bobby Brown, one little step. Because God knows we need a lot more steps, right, Bobby? But here we are, folks. We are seeing this initial, some people are talking about a little morphine to the wound. I'm seeing it as a one stitch here into this wound. We actually need this wound to be cauterized, which is painful. But let's look at this. It's a 3-month facility, which is allowing the banks over there to use European collateral to obtain U.S. dollars. So it's the other side of that U.S. dollar swap. They already have access to that U.S. dollar via the swap, but this is allowing the other side. So this should help out the liquidity position. And clearly, the liquidity position has been a problem. We've been talking about this. You know, a lot of these institutionally priced money funds have been trimming their exposure, thus not lending money over there. Therefore, liquidity is shrinking. The junk bond market has been obviously alluding to the fact that things are about to seize up over there. So this temporary band-aid, this one stitch, is one component we need, but it's not the fix-all and be-all. Obviously, we're enjoying the equity market bounce here, but we have seen this S&P bounce from 1135 to 1205 for the last month or so. But let's look at the balance sheet still of these banks. You know, if you look at these French banks, you're seeing, I think, SocGen up 15% today. Sensational move. Also keep in mind, folks, you're not allowed to short over there right now, so that does take a little bit into the equity gain we're seeing. But I think really the balance sheet is what we want to drill down on. And at what point do those balance sheets actually take the haircut, the necessary haircut on the Greece debt, as well as the Spanish, as well as the Portuguese, all these different sovereign debts we've talked about. No one's essentially really taken a haircut. We've just moved it down. So I think we would like to see this one step closer, but we're still far, far away. So we will see right now, you know, a flush out of gold. Gold, big $47 move to the downside. We're seeing the 10-year move up to about 2.08, 210. We haven't seen that move in a while. Bounce off that 129.02 level was the low there. We saw the 30-year get into the 138 handle. But I think this is all part of the volatility we have gotten accustomed to. So take opportunity here. Every time we've seen a price come down or a yield go up in the 10-year, it has presented a buying opportunity. I will beat that dead horse, folks, because I've been spot on since about 3.5% in the 10-year, and every time that's relented, come up for air, come down in price, you come in and grab those treasuries, and it's worked out well. So we're still going to continue to be in this holding pattern until we break out of this zone, either to the upside or to the downside. Try to stay agnostic, try to stay nimble, but at the end of the day, we're waiting for Uncle Ben. A big 2-day meeting next week, looking for more out of Merkel, more out of Sarkozy. So we're going to have to continue to move like Mick Jagger. We're going to continue to have to be nimble, be quick. But one other thing you have to remember is to be the hammer, not the nail.